Okay, now we're on to the DuPont Identity. So the DuPont Identity is all about return on equity. And students often think that, hey, it's just another way to calculate return on equity. And that statement is true, but that's not everything that the DuPont Identity does for us. So let's talk about why DuPont was so focused on the idea of equity, on return on equity. And it boils down to this: managers are clever. And they know that even with the same operations, the same assets, the same everything, they can boost ROE simply by taking on more debt and buying back shares. They can boost the ROE. And so if we are rewarding managers based purely on ROE, what will they do? They will simply boost the amount of debt in the capital structure. Now, that's going to boost the return on the equity, but it also boosts the risk. And so basically, you're just getting paid a higher return because you are taking on higher risk. The more money you owe, the riskier your business is. Does that make sense? My parents owe nothing to anybody and haven't since 1976. How risky is their situation? No risk. My wife and I owe less than $190,000. Which is pretty minor for people at our stage of life, right? What's the risk? And we make good money here at the university. What's the risk of us going under? Pretty minimal, right? I had a neighbor across the road. He was a spine surgeon, and he owned a brand new BMW M5. Anybody know? Mr. Fisher, is that a cheap car? No, it is not. So he had the brand new M5. The wife had a brand new Infiniti SUV because the BMW SUV was too small to carry around his brood of children. And so he's got his medical school debt, his student debt. He's bought this house, which is worth probably more than $100,000 more than mine because it has a finished walkout basement. And he's got this BMW M5. He is probably barely making his fixed payments every month. What does the riskiness of his situation look like versus me? Very risky. In fact, I would stand out on the driveway and he'd be looking bad. And I'd say, "What's up?" He'd say, "Mercy's not throwing me enough spines." Because he got paid by the spine. And so he was like, "Damn, why can't someone twist their back, right?" And so, well, he's not there anymore, so you guys, can't go look him up and try to figure out who I'm talking about. My point to you is businesses are exactly the same. The more debt that you put on, the riskier the situation is, and of course, risk and reward have to go together. That's why that ROE goes up. And so the question is, how can we keep these crafty managers honest? How can we break this ROE into pieces that will allow us to properly measure managers' performance? First, I'm going to tell you a little bit about DuPont. DuPont, do any of you know what DuPont is or was? Yeah, it's a big chemical plastics company, and for the longest time, they were like the thing. In fact, I've been in a DuPont factory, Parkersburg, West Virginia, making toothbrush bristles. You don't want to see that in order. By the way, always wash new toothbrushes before you use them. That's what I can tell you from my visit to that. It was a great plant, but the toothbrush strand is just going across the factory. People are walking by, coughing, whatever else. No, wash your toothbrush first. Okay, back to the story. DuPont is known for management excellence, and my example is a DuPont dynamite plant. You guys know what dynamite is? Okay, my dad worked in a dynamite plant in Carthage, Missouri from 1962 till I think around 2000 or so. And so that's how he paid our house off. That's where the money came from at our house. And dynamite plants are not all in one building. Why would you not put the entire dynamite factory under one roof?
feeling the whole obvious.
So you don't lose it all in one go?
Yeah, so you don't lose it all in one go. Now, where my dad worked, and you guys can look on Google Earth and you can see it, they had what's called a powder line. It was a line of small buildings. But the DuPont factory looked like this. And of course, there were more than, however many buildings have been up here, 8. But that's what the DuPont dynamite factory looked like. So if one of these blows up, hopefully this stuff doesn't go over and catch the next one on fire. Now, DuPont had a lot of accidents, fatalities on the night shift. Why do you think that the night shift is more dangerous than the day shift? Fatigue? Okay, so people, I know you guys don't realize this yet, but you're not meant to be awake during the night, right? You're meant to be awake during the day and sleep during the night. So it's called circadian rhythm, and it gets all thrown off when you work the night shift. Okay, so that's number 1. Number 2, when you hire new people, where do they go first, the night shift or the day shift? Night shift. Oh yeah, nobody wants to work nights, so that's where the newbies go and hope for someone on day shift to retire or die so they can move to day shift. Okay, so that means our new people are on the night shift. They're tired, and let's talk about the day shift. They are fresh because they just got up and they're happy. And also, what do you think happened to any stupid people on the night shift before they ever made it to the day shift? They got fired or they got killed, right? And so the day shift is a whole lot safer. Now, what they noticed at DuPont was this was so true. The other thing is the entire management staff is there during the day. At night, what do you think? You think everybody's there? No. And so what DuPont said is, well, what we're going to do is we're going to build a really nice house right here in the middle of the compound, and we're going to have the plant manager and his family move into the house. Why do you think that would impact safety on the night shift?
It's bad to blow up your boss.
It's bad to blow up your boss. Okay, so you're assuming the employees care about blowing up the boss. That's sweet.
I feel like the plant manager would be more attentive.
Oh yeah! Okay, so if I'm laying in my bed at 2 a.m. and I smell smoke at the dynamite plant, what am I gonna do? I'm gonna get up and I'm gonna run out there and I'm gonna try to put an end to the situation before everything goes to, right? Does that make sense? Also, if it were just the manager by himself, maybe he wouldn't be so motivated. But who else have we moved into the house? His wife and his kids. By the way, gentlemen, if you get killed, your wife's going to be mad at you. But if you get those kids killed, there will be no end to your sorrow. So, what do you think happened? Do you think the plant manager started to care more about safety on the night shift? Absolutely. Could you get by with doing this today? No, why not? Do you think the government would let you get by with that? I mean, this is back in the day when we probably had little kids working in coal mines, right?
I feel like you also have to
What's
pay
that?
them a lot more too.
Oh, the plant manager?
Yeah.
Oh no, we're not going to pay him anymore. Why?
I mean now.
Oh, yeah. Well, maybe, but we're going to offer him a house, right? A nice house. She's such a skeptic. Okay, questions? Okay, so that just gives you a little idea of these crafty people at DuPont, what they're up to. Here's what the DuPont Identity is. By the way, any formula that I put on a slide, do you think it should be on your note sheet for the exam? It's pretty obvious, but some people don't get that. So here is one you definitely want to have on there, and that is ROE is equal to, by the way, what do you think PM stands for? Profit margin, very good. And then TAT, what do you think that is? Total assets turnover. Total assets turnover. And then the last one is the equity multiplier. In fact, if you take profit margin times total asset turnover, you end up with net income over total assets, which is just ROA. So you can always calculate ROA if you have profit margin and total asset turnover. Now what happens when I throw all that stuff into a formula? I have expanded each one of those. Profit margin is net income divided by sales, and total asset turnover is sales divided by total assets. And then the last one is equity multiplier, total assets divided by total equity. If I go through there, notice that sales cancel out. Notice that total assets cancel out, leaving me with net income over total equity. So hopefully I've just proven to you that this DuPont identity does indeed give me ROE. Okay, now, why are we breaking it down into those three parts? And that's because each one of those parts actually means something. Profit margin, DuPont says that's a measure of operating efficiency. Remember, we said the way that we want to raise our profit margin isn't by decreasing sales. It's not by increasing the price of our goods. What did we say we wanted to do? Yeah, lower our costs. Get rid of these things. That's why profit margin is a measure of operating efficiency. And so what we want to do is watch that profit margin over time. It should be increasing. Now you say, wait a minute, I know how to fake this thing out. I can just raise the prices and they'll think that I'm very efficient. Except for one thing, what happens when you raise your prices? What happens to sales? Yeah, they drop. And so this total asset turnover would go down. And as a result, your asset use efficiency would go down. And so what we're going to tell managers that they've got to do is increase profit margin, increase total asset turnover while leaving equity multiplier alone. We have the capital structure that we want. You don't get to change that. So we want you to increase these other two things. By the way, I could lower prices and increase my total asset turnover by having greater sales then. What would that do, though, to my profit margin? It's going to go down. You can't cheat either of these measures and not hurt the other one. So that's the way that we need to set this thing up, is where the managers can't cheat. By the way, do you think managers would cheat if they had the opportunity?
Oh, yeah.
Absolutely. Absolutely, because they're human, right? Okay, so that's the DuPont analysis. Any questions? So, I've got a couple of ways here to do ROE. I've got net income over total equity. I've also got equity multiplier. I've also got ROA times the equity multiplier, because these two things multiplied together give me ROA. Do you think this kind of information might be useful for you when trying to solve problems? Yeah, you're saying, wait a minute, I can't figure out ROE because he didn't give me net income and total equity. Ask yourself, what did he give me? And you may find yourself with some of this information. Questions? By the way, the equity multiplier, if you need it and don't have it, what should you be looking for? It's equal to 1 plus something. What was that something? Yeah, the debt to equity ratio. So this equity multiplier, if I haven't given that to you, what you want to be looking for is that debt to equity ratio. The A student can put all this kind of information together. The B student, maybe this information. The C student, maybe there. Questions? So let's talk about some problems with financial statement analysis. Number one, let's talk about conglomerates. What's it?
Hi.
Yeah. Okay. What's a conglomerate?
Company that owns several different kinds of businesses.
Yeah, so a company that has, let's call them divisions in different industries. Now, why would a conglomerate be a problem for financial ratio analysis? Remember, we said you can only compare firms in the same industry. Well, what industry is a conglomerate in? And then students start to say, well, wait a minute, maybe what we can do is just come up with some sort of weighted average of the ratios for the different industries, and that would give us a good baseline for a conglomerate. If you are inside the conglomerate, maybe, but do you think businesses really give that kind of detailed reporting on a per unit? A lot of times we can't tell which divisions are making money and which aren't. For example, right now, if you look at Amazon's financial statements, they have basically three things. They've got the cloud thing, they've got the Amazon thing, or the e-commerce thing, and then they've got bricks and mortar. And the bricks and mortar includes Whole Foods and Amazon Fresh and Amazon Go, stuff like that. Can you tell how much of each one of those is in there? Absolutely not. And so only if you're inside the conglomerate might you be able to pull something like that off. So typically the answer is no. What if you have two similar conglomerates? My old employer, Halliburton, we were in a lot of lines of oil field service, and so was our competitor, Schlumberger. It looks like Schlumberger, but it's actually Schlumberger. And so far, it sounds like you could compare us, except for one thing. You don't know what the proportions are. We were greater in some parts of the business, and they were greater in others, so we can't necessarily do that. The other thing was this. We had an insurance company. Why? I have no idea. We had an insurance company, and Schlumberger also makes gas meters and gasoline pumps. In fact, if you're filling your tank, next time take a look. There's about a 25% chance that Schlumberger made the pay at the pump thing that you're using. They don't match up exactly. Therefore, we can't do ratio analysis comparison of one with another. And then there's seasonality. Seasonality, let's talk about inventory. For example, let's take the candy business. What's a big candy holiday? Easter, very
I
good.
said there's like three.
Yeah, there is, but let's just
Valentine's
assume.
Day, Easter, and Halloween.
Oh, and then there's Christmas candy too. So yeah, but let's just assume, for sake of argument, let's just pick one of those. Let's say it's Valentine's Day, right? So what does that mean? It means if you're making candy for Valentine's Day, actually let's use Easter because they tend to have, it tends to be weird companies that do that. So let's talk about that. So you're getting ready to make candy for Easter. Easter is typically late March, early April. When do you start making the candy? Before that, right? And so let's say that Easter has just happened. What should your inventory look like at that firm?
Very low.
Yeah, it should be very low. On the other hand, the sales for that same time period are going to be really high because I just sold all that inventory. My inventory turns are going to look amazing. Now, 3 months later, what am I doing? I'm stocking up on sugar. I'm stocking up on cocoa. I'm not selling squat, right? And so my inventory turns are going to look bad, 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 bad. And my inventory is going to grow. My sales are going to still be zero, right? My inventory turns are going to look awful right up until Easter, right? When I sell all that stuff and I no longer have any inventory. And so that's what we call seasonality. I can't compare the ratios of this company one to another, right, from one season to the next. What I have to do is compare against the same quarter in the prior year if I'm going to make any comparisons whatsoever. So seasonality can affect these ratios too. And then we have different accounting methods between countries. In the United States, we use the generally accepted accounting principles, or GAAP. In most of the rest of the world, they use IFRS, which is the International Financial Reporting Standards. We are moving slowly toward IFRS in this country, but we're not quite there yet. Now, I'll give you an example of the differences between these. In the US, under GAAP, when we do research and development, we have to expense that in the same period. And so our net income goes down, our assets don't change. But what about under IFRS? Well, you can actually say that you're creating an asset for your research and development once you reach technical feasibility. Now, folks, I'm a mechanical engineer, and I can tell you that you don't know whether you've reached technical feasibility or not until the darn thing is actually in physical form and working, right? I don't know how they come up with this timing or definition of technical feasibility, but somehow they do. And at that point, instead of expensing that R&D, they're basically investing in an asset. And so their net income is going to be higher because they're not expensing it. Their total assets are also going to be higher. So there are all sorts of weird little things between those two that are going to cause problems. Now, what does that mean? Let's get back to my old employer, Halliburton. We were an American firm headquartered in Houston, Texas. What accounting do you think we used? Yeah, GAAP, good old-fashioned GAAP. Our competitor, Schlumberger, was a French company, and they were headquartered in the Dutch Antilles or some tax haven place. What do you think they were under? IFRS. Even if we were in exactly the same businesses in the exact same proportions, we still couldn't have compared our numbers to theirs because of the difference in these accounting standards. Then we have differences in currencies between countries. I mean, there's the obvious thing of in China, 7 units of their currency is equal to 1 of ours. And so their net profit's going to be 7 times higher for an identical company. So we can't, that's the simplest basis. But let's talk about what are the other ways that this comes in. You could actually be, let's talk about Procter & Gamble. You guys know what Procter & Gamble is? Consumer products company. They are around the world. They have operations basically everywhere. I've seen their products in Europe, I've seen them in Asia, pretty sure they're everywhere except for Antarctica. So back to the story. Procter & Gamble is a US company, and so their financial statements are reported in what currency? Dollars. And so anything that goes on overseas, in order for reporting purposes, they have to convert that back to dollars for their financial reporting. And due to currency fluctuations, I might be saying, whoa, wait a minute, these foreign operations are falling down on the job. But it could just be as a result of the exchange rate. For example, right now the American dollar is stronger than it has been since 1985. And so these foreign operations that were reporting, let's say they were reporting $1 million in profit previously, now they're only reporting 900,000. Are they doing anything wrong? No, they're doing the same thing they've always done. It's just the shift in the currency exchange rate that's causing this problem. So that's another thing that can give us trouble. And then finally, we have differences in accounting for inventory. We have LIFO and FIFO. What do you think those things stand for?
Last in, first out.
Yeah, last in, first out, first in, first out. And so when we do this, are we actually talking about taking physically the last one on the shelf and selling it first? No. Physically, assume all these parts are identical. What we're taking is the cost of the last one I put on the shelf and counting that as the cost of the next one I sell. Now, why might that be helpful? Well, during inflationary times, which by the way, do we have inflationary times? Oh yeah. During inflationary times, that means we're going to be subtracting a greater cost because that last one in will be the most expensive. Now, that will make my gross profit look less, which will make my taxable income less. What will that do for me? What's it going to do to my taxes? Yeah, it's going to reduce them. Now, so far, this choice of which one to count as the cost of the thing that I sold has had no financial impact whatsoever. But now we're talking a real impact. Our taxes paid with real money. Yeah, and so if we can reduce those taxes, we've actually made our situation better, even though accounting for such things in LIFO make my net income look smaller because they've got that inflated cost. Now, of course, there's a problem when I do last in, first out. Those things that are left on the shelf are valued at old, stale prices. And so my inventory on the shelf is minimized compared to what it really looks like. And my cost of goods sold is maximized compared to what it really looks like. So if we have cost of goods sold that is inflated and inventory that is deflated, that's going to make my inventory turns look higher. And so it will look like I'm performing better, but am I in reality? Not really. Now let's look at FIFO. What's FIFO going to do? It's going to make your cost of goods sold lower because you're using the oldest, cheapest price. And it's going to make your taxes higher, but it's going to also leave that inventory on the shelf being valued more highly. And so the inventory turns are going to look lower at a firm that uses FIFO. So, which one should you be doing? What do we care about in finance? We care about cash flows. During inflationary times, which one of these leads to the greatest cash flow? LIFO, right? LIFO leads to the greatest cash flow because it reduces your taxes. And when I first went to work for Halliburton, 1994, they had just the year before switched from FIFO accounting to LIFO. And it was amazing what it did for our tax bill. And by the way, perfectly legal. Perfectly legal. Under United States law, it's perfectly legal to use either one of these. Now, by the way, Obama tried to get rid of LIFO. Any idea why?
He wants more tax money.
He wants more tax money. Why should we let the shareholders have that money? I can do something nicer with it, right? Politicians always think that.
Typical government.
Yeah, typical government perspective, right? Okay, so that's why we see differences in our ratios as a result of LIFO and FIFO. Now, can we make adjustments to convert IFRS to GAAP? Yes. In fact, Dr. Jones, my department head, teaches a course that tells you basically how to do that. Can you make adjustments for FIFO versus LIFO? Yes, I've done it before. It's hugely painful. They have what's called a LIFO reserve or a FIFO reserve, and there's all this machinations that goes on. You can do it, but these are things that you need to watch out for when you're doing this kind of work to avoid making mistakes.